Today, investors stand by for a reality check. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. The Dow stumbled on Thursday to close out the shortened US trading week, despite mostly better than expected quarterly results from major Wall Street banks, and tech stocks were in a sea of red. US markets will be closed on Good Friday, and of course the ASX is closed on Friday and Monday, as are most of the major European markets. Thursday marked the monthly expiration of option contracts, an occurrence that has in the past helped amplify stock market gyrations as investors make adjustments to account for millions of expiring options contracts on stocks, ETFs and indices. Amid the carnage, John Lynch, the Chief Investment Officer at Comerica Wealth Management, said investors are set for a reality check. After almost 2 years of earnings per share growth at a multiple of historical averages, this year's opening quarter is projected to deliver single-digit profit growth for the first time since the fourth quarter of 2020, he said. It's a tough environment, said David Donabadian, Chief Investment Officer at CIBC Private Wealth Management. Inflation numbers are going to stay very high and haven't peaked yet. And we're also going to start to see a deteriorating outlook for economic growth. Not a recession, but significantly slower economic growth than certainly we'd anticipated as the year began. In fact, wherever you look, there is pain. For example, US mortgage rates in the US surged, reaching 5% for the first time in more than a decade. The average for a 30-year loan jumped from 4.72% last week, according to Freddie Mac. The last time rates hit 5% was in February 2011. Borrowing costs have been soaring since the start of the year, tracking the jump in yields for 10-year treasuries. Last month, the Federal Reserve raised its benchmark rate and signaled more increases to come in an effort to slow inflation, which has accelerated to the fastest pace since 1981. Higher mortgage rates are adding to pressure on would-be buyers in a market where purchase prices are still skyrocketing 2 years into the pandemic housing boom. While some people are putting off their searches after getting priced out, the supply of listings is so tight that bidding wars remain common. At 5%, borrowers on a $300,000 mortgage will pay $1,610 a month. That's up $327 from the end of last year, when rates averaged just 3.11%. Sidebar here, of course, those prices are so much lower than in Australia, where the impact of rising interest rates are even more severe. The hit to buyer affordability since the beginning of the year is equivalent to an additional 20% increase in home prices, according to Greg McBride, Chief Financial Analyst at Bankrate.com. For home buyers under 35 years of age, a 5% rate is uncharted territory, he said. The speed at which rates are going up will cool the housing market by reducing demand, but that may only mean housing goes from sizzling to warm. Demand still exceeds what is a record low level of supply. On the broad economic front, investors digested a weaker picture as data showed initial jobless claims rose more than expected, while the latest retail sales report flagged the impact of red-hot inflation on the consumer. In fact, US retail sales picked up in March, helped by a surge in gas station receipts that masked mixed results in other large spending categories as consumers contended with decades-high inflation. The value of overall retail purchases climbed 0.5%, according to data from the Commerce Department. While that was just shy of expectations, the prior month was revised up sharply to show a 0.8% increase. The March increase was led by an 8.9% jump in spending for gasoline, but excluding receipts at gas stations, sales actually fell 0.3% last month, as vehicle and e-commerce purchases, the two largest spending categories, declined. The figures aren't adjusted for inflation, by the way. In some discretionary categories, such as apparel and restaurant spending, the rise in nominal sales outstripped inflation, and suggested that the easing in pandemic-related restrictions is helping consumer spending, while in other components it was clear that inflation played a large part in boosting spending. Omar Sharif, founder of Inflation Insights, said in the note. Still, economists remain sanguine on the strength of the consumer, citing excess savings built up during the pandemic, but of course not equally spread across all households as in Australia. We remain quite constructive on the outlook because of the combination of excess savings and robust wages growth, particularly in the bottom half of the income distribution, Jeffries said in the note. The fall in back stocks comes in the wake of rising Treasury yields, which tend to boost the margins on loans made by banks as investors bet the Federal Reserve will lean aggressively on monetary policy tightening to curb inflation pressures. In a recent interview, New York Fed boss John Williams said a half-point move was a reasonable option for us because the federal fund rate is very low. We do need to move policy back to more neutral levels. The yield on the US 10-year note leapt 13 basis points to 2.83 and continued higher. The 2-year rate was around 2.79%, and the US bond market, of course, closed early for the Easter break. In a note, Capital Economics' Franziska Pamas said a review of historical moves in the 10-year yield during the 8 major Fed tightening cycles since 1970 indicates the yield will rise higher, though perhaps at a slower pace. They expect the 10-year yield to rise to 3.25% by the end of 2022, peak at 2.75% in mid-2023, and drop back to 2.25% by the end of 2023. We also project that the 10-year yield will fall further as the first rate cut nears, ending 2024 at 2.75%, they said. Interest rate futures were almost fully pricing in a half-point hike at the Fed's May 3rd and 4th meeting, when officials could also announce the start date for beginning to shrink their nearly $9 trillion balance sheet. Williams voiced confidence in the Fed's ability to soft land the economy, cool price pressures without forcing a steep rise in unemployment, and said the Fed's forward guidance communications around its policy plans had already got the ball rolling. We see a dramatic, significant movement in yields and financial conditions over the past several months, and that's already positioning policy well to get supply and demand back into balance, he said. Now, the previous day, the Bank of Canada raised its key interest rate by 0.5 percentage point in its biggest hike in 22 years and said rates are poised to move significantly higher as it aggressively wrestles inflation down from a 3-decade high. Policymakers, led by Governor Tiff Macklem, increased the central bank's overnight benchmark to 1% on Wednesday. Macklem said he expects rates will return to what they consider the neutral rate of 2 to 3%, with policymakers prepared to move forcibly if needed. The bank also said it will stop purchasing government bonds later this month to start shrinking its balance sheet, another form of stimulus withdrawal. The economy can handle higher interest rates, and they are needed, Macklem said at a news conference in Ottawa. Short-term bonds fell after the report, pushing Canada's benchmark 2-year yield to as high as 2.346% before reversing those losses. In what policymakers describe as a substantial upward revision, inflation is now seen averaging near 6% in the first half of 2022, before easing to about 2.5% in the second half of next year and to around its 2% target by the end of 2024. Inflation is projected to average 5.3% in 2022 versus forecasts in January of 4.2%, and price growth will slow to 2.8% on average over 2023 versus previous forecasts of 2.3%. The Bank of Canada has also provided some details of its quantitative tightening plans. The bank no longer plans to replace federal bonds as they roll off their balance sheet starting April 25th, and over the next 12 months, about a quarter of the net 350 billion Canadian dollars or 275 billion US in government debt acquired during the pandemic will mature, pushing up yields and complementing the increase in the policy rate. A hawkish pivot, of course, is also expected in the US, where Chairman Jerome Powell and other policymakers have put a half-point hike on the table for the Federal Reserve's meeting in May. So back to the US market outturn, where the Dow Jones Industrial Average was down 0.33%. The S&P 500 fell 1.22%, while the Nasdaq slipped 2.1%. Major Wall Street banks, including Goldman Sachs, Morgan Stanley, and Citigroup, reported first quarter results that beat analyst expectations, but Wells Fargo fell more than 4% after reporting a decline in its quarterly report. Now, the point to underscore is that the pace of the surge in yields has placed growth sectors of the market in the crosshairs, with big tech leading the decline. Apple fell 3%, while Alphabet, Amazon, Microsoft, and Meta platforms were all down more than 2%. And Twitter failed to hold on its gains, as many doubt that Tesla's chief executive Elon Musk's $54.20 share offer to take the social media company private will succeed. Musk took aim at Twitter with a $43 billion cash takeover offer on Thursday, with the Tesla CEO saying the social media company needs to be taken private to grow and become a platform for free speech. I think it's very important for there to be an inclusive arena for free speech. Musk, already the San Francisco-based Twitter's second largest shareholder, said at a TED Talk in Vancouver when asked about his bid. Musk made the bid on Wednesday in a letter to the board of Twitter, the microblogging platform that has become a global means for communication for individuals and world leaders, and it was made public in a regulatory filing on Thursday. His offer price of $54.20 per share represents a 38% premium on Twitter's April the 1st close. That's the last trading day before his 9.1% stake in the social media platform was made public. Musk, the world's richest person with a $273.6 billion fortune, according to a Forbes tally, rejected an invitation to join Twitter's board on Saturday after disclosing his stake, a move analysts said signals his takeover intentions, as a board seat would have limited his shareholding to just 15%. Musk, after his TED Talk, hinted at the possibility of a hostile bid in which he would bypass Twitter's board and put the offer directly to its shareholders, tweeting, "It would be utterly indefensible not to put this offer to a shareholder vote." Twitter was evaluating the offer, with guidance from Goldman Sachs and others. The company was also preparing a poison pill as a protective measure against Musk raising his stake. Shares in Twitter fell 2% in afternoon trading, and investors were not immediately convinced. Saudi Arabia's Prince Alawid bin Talal tweeted from his verified account about the deal, describing himself as one of the largest and long-term shareholders of Twitter. Musk's offer undervalued the company, and he rejected it. Musk, for his part, told Twitter it was his best and final offer, and said he would reconsider his investment if the board rejected it. "This is not a way to sort of make money," Musk said during the TED Talk. "My strong intuitive sense is that having a public platform that is maximally trusted and broadly inclusive is extremely important to the future of civilization," Musk added. "The big question for the Twitter board is now whether to accept a very generous offer for a business that has been a serial underperformer and tends to treat its users with indifference," said Michael Hewson, the chief market analyst at CMC Markets. "In our view, the deal does not get done at this level, and Twitter's board will not view this offer or Mr. Musk leading a change in the company as in the best interest of the company or the shareholders," Wedbush said in a note. On Wall Street, 9 of the S&P 500's 11 industry sectors were lower on Thursday. Energy edged up 0.4% and utilities were up 0.1%. Financials led the slide after Goldman Sachs, Morgan Stanley and Citigroup reported quarterly earnings, which was somewhat better than expected, though executives were highly cautious about the outlook. Energy sidestepped the sell-off, underpinned by rising oil prices on fears about tightening global supplies as Russia and Ukraine look set to engage in a massive land battle in eastern Ukraine. The volatility index was up 4.03% to 2270. Gold futures for June delivery was down 0.6% to 1,972, while the WTI crude oil index for May rose 2.09% to 106.42, while the Brent crude June contract rose 2.45% to 111.44. The euro-US dollar was down 0.51% to 1.08, while the US dollar index futures was up 0.4% at 131. And the Aussie dollar slid 0.5%. Australian blue chips edged higher on Thursday to help push the market to a gain for the week, in a day marked by the best session in more than a year for Qantas. The S&P ASX 200 added 44 points to 7,523 for a gain of 0.6% for the day and for the shortened 4-day trading week. The broader S&P All Ordinaries gained 50 points to 7,822 to advance by 0.6% on Thursday. The season mirrored a strong day on Wednesday when Wall Street had pushed the S&P 500 1.1% higher and favoured travel stocks. This suggests weakness early next week, by the way, as the US traded lower the following day. But the earlier positive sentiment helped to drive local travel shares, with Qantas trading 7.1% higher to $5.45 and Webjet adding 7.5% to $5.85. The jump for Qantas was the best since November 2020 and pushed the share price to the highest level in a month as investors showed fresh optimism for one of the most beaten down corners of the share market through the pandemic. The day's biggest decline was suffered by the Bank of Queensland following results that underwhelmed the market and included cautions about a squeeze on margins. The bank's shares fell 6.3% to $7.99. There was very little good news in their results, frankly. Shares in Unity, the broadband provider, rose 2.9% to a record high of $4.96 after the company said it had agreed to a $3.6 billion takeover bid from Morrison & Co. and Brookfield Asset Management. The agreement comes after a competitive process that included an approach from Macquarie Asset Management. Shares in Allchem traded 2% higher to $13.52 after the Australia and Argentina-based lithium carbonate producer said it would triple production by 2026 in an effort to maintain a 10% share of the global market for the commodity. The best performing sector among blue chips was materials, which advanced 1.3%, while the day's laggard was the financial sector, which fell 0.3%. Bitcoin slumped 3.4% to under $40,000 on the day that North Korean-tied hackers were reported responsible for a $620 million cryptocurrency heist last month, targeting players of the popular Axie Infinity game, according to US authorities. The hack was one of the biggest to hit the crypto world, raising huge questions about security in an industry that only recently burst onto the mainstream thanks to celebrity promotions and promises of untold wealth. Last month's theft from the makers of Axie Infinity, a game where players can earn crypto through gameplay or trading their avatars, came just weeks after thieves made off with around $320 million in a similar attack. Through our investigations, we were able to confirm Lazarus Group and APT-38, cyber actors associated with North Korea, are responsible for the theft, the FBI said in a statement. Lazarus Group gained notoriety in 2014 when it was accused of hacking into Sony Pictures Entertainment as revenge for The Interview, a satirical film that mocked North Korean leader Kim Jong-un. North Korea's cyber program dates back to at least the mid-1990s, but has since grown to be a 6,000-strong cyber warfare unit, known as Bureau 121, that operates from several countries, including Belarus, China, India, Malaysia and Russia, according to a 2020 US military report. North Korean hackers stole around $400 million worth of cryptocurrency through cyber attacks in digital currency outlets last year, according to blockchain platform Chain Analysis. In the case of the Axie Infinity heist, attackers exploited weaknesses in the setup in place by the Vietnam-based firm behind the game Sky Mavis. The company had to solve a problem, the Ethereum blockchain, where transactions in the Ether cryptocurrency are logged, but is relatively slow and expensive to use. So to allow Axie Infinity players to buy and sell at speed, the firm created an in-game currency and a sidechain with a bridge to the main Ethereum blockchain. But the result was faster and cheaper, but ultimately less secure. The attack, targeting its blockchain, netted 173,600 Ether and $25.5 million worth of stablecoin, a digital asset pegged to the US dollar. So the point I want to really make here is that whether you're thinking about crypto, whether you're thinking about the main markets, or indeed pretty much anything, there's a lot of uncertainty about. In fact, the only bright quarter at the moment are commodities. And by the way, that's one reason why the Australian market is doing somewhat better than some of the others around the world at the moment, because, of course, we are very strong into commodities. But it'll be interesting to see how that plays out. Certainly, being in commodities at the moment looks to be the only more secure option there is. But even that, well, it's fraught with danger in my view. So I'm afraid there's no hiding place. Investors better get used to more bumpy air ahead. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.